Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar, the news and research you need to start the week off right in Bitcoin. We had a pretty active week in the markets last week, and we're likely going to have another busy week this week. In today's issue, we're going to talk about last week's inflation reading of plus 80 base points in the US, which rocked equity markets. We're going to talk about why that was and what implications that could have in the medium to long term. We're also going to talk about the Bitcoin futures markets, where open interest has dropped 33% since the April peak. We're going to discuss implications of that as well. And last but not least, there's a lot of talk right now around inflation in the United States, and the Fed holds a view that inflation will be transient or transitory. We're going to talk about why the Fed thinks this way, what data they're looking at, and what potential implications that may have for Bitcoin. So, lots to cover today. Grab your coffees. It's going to be a good one. So starting as we usually do with Bitcoin, we see here from the price action that it was a rough week for Bitcoin and markets in general last week. It all started on Wednesday last week when Elon Musk tweeted that Tesla would no longer be accepting Bitcoin for vehicle purchases. And it also mentioned that they are actively exploring cryptocurrencies that consume less than 1% of the energy that Bitcoin consumes. There were several articles about this last week. The one you have behind your screen is just one of them. The news handed Bitcoin, if we go back to the daily charts here, we can see that the chart from Wednesday essentially was the second worst daily close in Bitcoin in the year 2021, closing Wednesday session down 13%, as we can see from here. Now, that was Wednesday. On Thursday, we got news that MicroStrategy had purchased an additional $50 million worth of Bitcoin, bringing their total holdings up to 91,850 Bitcoin at an average price of 24,403. So we see that MicroStrategy continues to do quite well on its Bitcoin purchases so far. Then the roller coaster, the Elon roller coaster, continued on Sunday evening. At 2:48 p.m. Eastern, Mr. Musk published a very cryptic tweet implying that Tesla either had sold or was considering the sale of its Bitcoin reserves. The time of the tweet at 2:48 p.m. we can see coincided with the low of the session. That was yesterday. And today, actually, we see that Bitcoin has continued to go or move lower after that news came out. So, again, just to recap Bitcoin's weekly performance, it closed last week down 20.34%, closing in at $46,444. This was Bitcoin's third worst weekly price drop since 2019. Just something to keep in mind. Now, just briefly, why is Elon doing this? We don't know, frankly. Elon, if you're reading this, please stop. Or if you're watching this, please stop. One hopefully incorrect hypothesis is that this could be part of a broader plan. For what it's worth, Dogecoin has a very small market capitalization relative to Bitcoin, which means it's easier to move the price. The second is Dogecoin doesn't have its own ASIC miners. It is merge mined with Litecoin. And lastly, consider also that Tesla has a history of quirky and controversial product lines. They have produced red shorts in the past, toy cars, and even a tequila line. So an environmentally friendly Doge ASIC miner is certainly not out of the question. Now, moving that aside, let's look ahead at what the Bitcoin markets are telling us and see if we can find some signs. I guess rather than maybe best to show you, we're starting to see some signs that the Bitcoin markets continue to deleverage. One such sign is the open interest in the Bitcoin futures market. So as we see here in the on April 13th at its peak, there was an open interest in the Bitcoin futures of $27.4 billion. We see that that number has now come down to $18.1 billion. So from their peak, again, from 27.4 to 18.1, that is essentially a reduction of 33% in open interest. Now, as future markets traditionally use a lot of leverage, this is a good sign potentially for price volatility. Now, similarly to this trend, we're starting to see the flattening of the futures curves for Bitcoin, and even in some cases, some slight backwardation. So backwardation is when the price of a future month is trading below the current price. So again, we're starting to see this in Kraken's May contract, as you can see behind your screen. Now, so that's essentially it. It means that the expectation of some of the futures contracts is that Bitcoin is going to be trading lower than where it is today. So just for context, traditionally, Bitcoin has what's called a pretty healthy contango on its curve. So as you can see, most curves just go upwards and to the right. In some cases, they start dipping below, and that's what's called backwardation. So again, this is atypical to see in Bitcoin's future markets, and it tends to, we can interpret this, again, as future markets hold or traditionally use a lot of leverage, as less and less activity in the sort of highest leverage part of the Bitcoin market, which typically is a good barometer for leverage in the system in general. Now, to wrap it up here, let's look at the option markets and what they are pricing as far as Bitcoin's probability. So the June 21st contract, so these are the contracts that expire in the last Friday of June. They are currently pricing a 30.83% probability of Bitcoin being above $50,000 on the third Friday of June. So again, something to keep in mind, and we will continue to talk a little more about what we can expect in our What's Ahead section later today. Moving over to the S&P 500, we see here from the chart that the S&P had a tumultuous week last week, finishing down only 1.3% after being down 4.7% intra-week. This sell-off started Monday morning as the markets continued to digest the inflationary implications of the most recent payroll report that came out the previous Friday. Now, on Wednesday, when the consumer price index reading hit, the market sold off by 2.14%. So let's just go back to the chart on Wednesday, and here's the big drop that we were referring to on Wednesday. Now, on Thursday and Friday, the market tried to stage a recovery, but as we can see, it could not make it all the way back to the levels where it started off the week, which means that it essentially closed the week down 1.3% for the S&P 500. So the consumer price index reading of plus 80 basis points, so almost 1%, on Wednesday rocked capital markets, as you can see. It wasn't just the S&P that came down. If we look at the Dow Jones, it also had a pretty down week. Again, if we just zoom out into the day so that we can see the performance on Wednesday, pretty bad day, down 2%. Again, looking at the NASDAQ, similar price action, pretty down day, down 2.62%. So this is, why did it rock the market so much? Well, it rocked the markets because it was way higher than analysts' expectations. So analysts were expecting an increase of the CPI of 20 basis points. The reading that came out was 80 basis points, so 4 times what analysts were expecting. Now, what does this mean? It means that the Fed is getting closer to its inflation target of just north of 2%. As soon as these targets are met, the low interest rate environment could end, putting pressure on corporate earnings and equity prices, as we can see from price action after the news came out. Now, the yield on the 10-year note also rose 3.68% last week, and markets will continue to monitor this trend as the yield on the 10-year notes had been taking a breather for quite some time. Additionally, let's just take a look here at the yield on the 10-year. I'll go back to the weekly so that's easier to appreciate. But we see that last week it closed at an increase of 3.68%, even though it was actually significantly higher intra-week. Looking at the dollar, we see that last week it also had a positive week after a big breakdown that we even covered and highlighted in the last issue. So again, the trend still continues, or it still seems like it will be lower for the dollar. But again, we see that in this rebound last week, it actually tested that trend line that we had highlighted. So again, keep this dynamic or this trend and keep close attention to this, because again, the market had taken a breather because the 10-year had stopped rising. Now, with fears or data that shows higher inflation is coming, look for some upward pressure on those rates. Now, lastly, again, speaking of the rates, because of that reading last week, we see that the US money markets are now pricing a 100% probability of a 25 base points rate increase by the US Federal Reserve by December 2022. Prior to that reading, that probability was at 88%. So again, market now fully convinced that the Fed will do some action or some increase in rates by the end of 2022. Now, in terms of corporate earnings that are relevant to Bitcoin this week, we have Canaan, the publicly listed ASIC miner or ASIC ASIC manufacturer rather, reports earnings before the bell this Thursday. So we'll keep a close eye there for any potential insight to Bitcoin and the Bitcoin mining industry. Moving over to gold, we saw that gold actually had its highest weekly close in almost 6 months last week. It was up 60 base points at $1,842 an ounce. Now, despite it enjoying some pretty healthy price action last week, the rally, according to some, could have been even better had it not been for rising yields and the soaring US dollar. So for that, we can see the headline behind your screen right now. And essentially, the rally, as we mentioned, happened despite a rising dollar. We see that the dollar actually had a positive week last week. Not typical to have a positive week for the dollar and a positive week for gold. So again, interesting to see some strength here in this breakout of this trend for gold. From a technical standpoint, as we've mentioned here, and based on some of these trend lines that we've highlighted, gold is showing continuation after breaking out from this multi-month downtrend that essentially has been going on since August 2020. And so given the current backdrop and given the current technical setup, this trend is likely to continue. Moving over to the FTX DeFi index, we see that last week it was down 2.41% at 14,981 points, but it was only down 2.41%. Compare that to Bitcoin's drop of 20.34% and Ethereum's drop of 8.72%. So again, we continue to see that DeFi, again, continues to show relative strength versus Bitcoin and Ethereum. Investor appetite in the space continues to heat up with the headlines that we saw last week, including that very prominent hedge funds, including Steve Cohen's Point72, are setting up DeFi funds. For context, Point72 was one of the main hedge funds that were short GameStop into that short squeeze saga. So again, these are pretty prominent names, and they are now setting up specific funds to take advantage of these arbitrage or market opportunities in the DeFi space. So again, pretty meaningful. Another interesting news that went somewhat unnoticed by crypto media last week was the fact that Silvergate Bank out of the US rose on its shares rose on a deal to issue Facebook's DM coin, which is going to be Facebook's new stable coin. Silvergate was up 16% after that announcement. Now, again, just to bring you back to the chart, notice how DeFi has continued to lead the way higher, moving higher, when markets move higher, DeFi moves faster and higher than Bitcoin and Ethereum. And then when the market moves lower, DeFi is dropping less and less than these other two. These are signs of latent demand in this sector. So we're gonna continue to pay attention to these trends and the price action dynamic between the three. Moving over to our Bitcoin mining difficulty commentary, we see that difficulty reached a new all-time high on Thursday after the most recent difficulty adjustment brought difficulty north of 25 terahashes. The increase of 21.5% in difficulty was the largest difficulty increase in 7 years. So pretty amazing. Similarly, as you can see behind your screen, the mempool has come down to normal levels, and transaction costs were at 6 sats per VByte as of last night for next block confirmation. So again, really, really fun to watch, or really, really great to see. Transaction costs are now well within normal. Transaction speeds should be well within normal as well. And quickly, a Taproot activation update. We are seeing that as of this morning, about 18% of all miners are signaling for the Taproot upgrade. So, please support Taproot. And we're very excited to see this upgrade come through onto the network. And as always, we leave you with what's ahead for the week. In terms of announcements and important data, this week, we have the Federal Reserve Vice Chair speaking this morning, and the Federal Open Market Committee meeting minutes will be released this Wednesday. The market will be definitely looking to read the tea leaves in the meeting minutes for clues on when the Fed may be looking to raise rates. Now, again, so much talk about the Fed. Wanted to spend a minute to understand the Fed's transient inflation view. So why does the Fed think that this inflation surge that we're seeing is only temporary? So again, there's a heated debate around inflation in the US. And to kind of break down the two sides, some proponents believe that once inflation heats up, it'll be tough to put the genie back in the bottle, and the Fed can have a hard time essentially reining back inflation pressures. Now, this is not to say that the Fed does not have the tools to do so. Rather, it is saying that it cannot rein back inflation without inflicting huge damage to capital markets and the economy in general, thereby slowing down or stopping in full the recovery. Now, the Fed's view at a high level is that the current inflation numbers are a result of several factors. One, the low basis effect. So the fact that we're comparing today's numbers to essentially mid-pandemic numbers last year, of course, sets the stage for some pretty amazing percentage year-over-year growth. So they believe this is a big part of why these numbers are so impressive right now. The second one is pent-up economic demand. Because of the lockdown, there have been supply and demand imbalances, projects have been delayed, etc. So all this pent-up demand essentially is putting inflationary pressures on prices. And the last one is that there have been supply chain dislocations because of manufacturing and logistical disruptions due to the pandemic. Some of this could be attributed to the reason to the surge in lumber prices. A lot of it has to do with supply chain dislocations. Now, furthermore, the Fed views that some of the proposed uses for this fiscal stimulus out of the Biden administration, such as the infrastructure bill, are intended to have long-term deflationary effects. To explain, as you provide more incentives to businesses, you will create more businesses. As you build more highways, this will enable more businesses to compete. And so these two trends essentially combine to create deflationary pressures due to increased competition over the long term. Now, in short, once supply chains are back in check and businesses go through a couple of more inventory cycles, price levels will level off and inflationary pressures should subside. This is essentially the Fed's view. The reason markets are so jittery is because until now, this conversation was very hypothetical. The Fed and the US government had been spending to no end and holding interest rates at rock bottom levels without ever seeing a glimpse of inflation. Last Wednesday's consumer price index read for all items increased by 4.2%. That is the highest month-over-month increase since January 2008. It means that the Fed is starting to deliver on its inflation goals, and it makes this conversation very, very real. So the market will continue to pay very close attention to any type of numbers that could signal current or potential future inflation. So again, we've covered a lot today. It's been a very big week, and as always, we're going to keep you updated of any relevant news through our social media or right here through your Bitcoin economic calendar. If you enjoyed the show today, if you learned something, I welcome you to like it, share it with your friends, subscribe to our channel, and if you don't yet have a Ledn account, check out Ledn.io and learn how you can start earning 6.1% on your first 2 Bitcoin and 12.5% on your USDC. We also have great Bitcoin-backed loan products and B2X to double your Bitcoin through a Bitcoin-backed loan. Thank you, everybody. Have a wonderful week and see you next time.